There we go.
Give me a count to 3. 1, 2, 3.
3, 2, 1.
Wait,
Okay.
can we have Ben say confident in his assertions? Overconfident. 1, 2.
Very confident, in my assertions.
All right. Sonali, I just got back from Las Vegas.
Oh, yeah?
Yeah.
For fun or for work?
For work. All I do is work.
Las Vegas is my nightmare.
It's, you know what?
I love it. I love
had
all
fun.
the depression and the tears. And
36 hours, right?
I had fun. I was there 18 hours. And
That's probably about right.
I was there on a Monday and a Tuesday. Or no, a Tuesday and a Wednesday.
And it was still hopping?
Yeah, the encore, so the encore is always going.
Yeah. I'd go for the Sphere. I've never been to the Sphere.
The Sphere is insane.
Yeah,
it's
you've
one of the
been?
things that lives up to the hype. I saw
Yeah.
you too.
All right.
I'm going back in May
Okay.
for No Doubt. I'm so excited.
Michael and I are going like 2 weeks to Vegas.
What are you?
For
Are you
the
going to see
FPA
something at the
conference.
Sphere?
We were going to go, it's Wizard of Oz. But I'm
Just
like,
go.
eh.
Just go.
To go see a movie?
It's so much more than a movie. It's a fully immersive experience.
I don't know.
Just go.
All right. You sound like a Chamber of Commerce person. from
No,
Vegas.
because why wouldn't I mean, unless you have other cool things to do.
Blackjack.
How much blackjack can you really
so
play?
look, we better like play a lot
12
of blackjack.
hours.
Josh,
Really?
brought this back for me and Chris.
Yeah, check that out. That's a troy ounce of silver.
You ever see this before? This is the top.
It
So-
crashed right as he bought it.
So can I tell you something?
Isn't
I
this
walk.
cool?
I walk. There's
From
a guy with coins, gold coins, silver coins on a display at the event that I'm at, and I go.
Better as a hard asset. Good for alternative.
So I go, I want to buy a few of those. How much are they? He goes, well, it's an ounce of silver. I'm like, okay, well, I don't know offhand what that means. I don't know how much an ounce of silver is. He's like, no problem. I'll tell you how much it is. He looks on the Bloomberg app for the price of silver. He goes, it's 48. So I'm like, okay, 2 please. He's like, no problem, no problem.
That's how he charged you?
That'll be $96. Yeah,
Go figure.
like right off the quote, right off the quote screen, because it's an ounce of silver. I thought that was.
He wasn't comfortable with the Google pricing?
I think that was kind of cool.
Wait, can I send one of you a chart I love?
Yeah.
We don't need to use it. It's just kind of interesting and informative. What's your email?
We want it.
Michael at Ritholtz.
What are you, crazy?
I think people can figure it out.
All right.
Michael.
I get a lot of emails.
Ritholtz.
You got hosed. It's already down to $42 an ounce.
Bellagio has a new Carbone restaurant. That's Carbone seafood. You have to take a boat to get to it.
Are you joking?
No, I'm not.
Wait,
Is
where
it
are we? Where are we
Ritholtz.com?
staying in Vegas?
Wealth.
With
Ritholtz.
Ritholtz, okay.
We are staying at the casino. I don't know which hotel we're staying at.
Okay.
Ben and I are going for a night.
So I'll tell you what I've learned. I stay at the Tower Suites.
Oh, we're at the MGM Grand.
Okay.
There are 3 of these.
You stay where there's no casino, right?
No, there is, but it's a separate building. It's connected. So there's the Waldorf, which is just a tower. It's like a Manhattan high rise. None of the bullshit in the lobby. Like you don't hear ding, 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 ding. No, none of the dregs of society.
I need the bullshit. I need the stale cigarette
That's what
smoke
Vegas
in the
is
air.
for.
I need it all. I love it.
And then there's
Where are you
the
from, Batnick?
the Encore Tower Suite, separate entrance you pull up to. There's nobody there. There's a security guard and a few people working behind the desk. You check in 2 seconds. You walk into your elevator. You go right up, and you're almost like in an apartment building. Not
I was
in a
in LA,
casino.
sort of. I was in Nashville, Opryland. Have you been there?
Yes,
It's like Vegas.
Opryland.
Opryland? I've heard
Opry.
both. Interesting.
Grand Ole Opry.
Grand Ole Opry.
Yes,
Ah.
I say an opera.
I didn't like it.
You went to the wrong thing. You're supposed to go to the Ryman Auditorium.
Can
Can we do 10 seconds on this? It's important, actually. The
He's a travel
original,
agent now.
the original Grand Ole Opry
Okay.
was at this 1800s era church that became the Ryman Auditorium.
Okay.
That's where like Dolly Parton became famous.
Yeah.
That's like for country music,
Yeah.
maybe for all of American music. That is like that's like the Vatican,
Okay.
the Ryman Auditorium.
I gotta try it.
The Grand Ole Opry that they tape like a TV show. That's
Good.
20 miles outside of Nashville. You
Who
have
is
to-
this for?
for Sonali?
It's
That's the tourist
I'm
trap
being
you went
mean.
to.
I went to, well, it was very corporate, right? It was like the
Yes.
Delta Lounge this and like, you know,
Right.
another.
So if you really want to see like a country music show in the heart of Nashville
that
in
I do want,
downtown,
Grand Ole Opry.
that's the Ryman Auditorium.
I gotta brush up on my
RYMAN.
Nashville. Beyond that,
And it's
Nashville's the most
awesome.
amazing place.
It really is.
I'd move there if I could.
We have employees there. It's pretty sick because You have Belmont, which is like one of the best music colleges in the country. Vanderbilt is right downtown. You have all of like Google and everybody is opened up. And then you've got the whole music component to it, like Broadway, with all the honky tonks and all
so you've
that.
got good music taste, but like, is Batnick like
He doesn't like music.
just betting on the side? Like, what are you doing
Oh, yeah,
over there?
yeah.
Batnick just wants
That is
to
a
be
cool
casino.
Nashville. There's live music everywhere you go.
It's so cool.
We saw like a band in a Holiday Inn there, and it was amazing.
Everywhere.
Everyone's carrying a guitar down the street. It's so cool.
So, Sonali, you're the perfect person to have here this week. We're going to be talking a lot about the cockroaches. And I want to say this before we get into the show. So I, relatively early on, probably 2 years ago, was like, why the am I getting so many emails from private credit companies? What is happening? Like I've been on this corner for a long time now, right? It's been a minute.
Mm-hmm.
And I also think that a lot of the conversation that is happening, and I'm like, how did I turn into like the voice, the spokesperson for the private credit industry? It was never, that's not like what I'm here to do. But I think a lot of the hyperbolic fears are just way overblown.
You know, it's like any other asset class. Why would you paint it with a broad brush? It doesn't make sense to me. If you're picking fund managers in public markets, you would look at those fund managers, you would look at their track record, you'd see how they've been doing over time. You would see, importantly, which to me, this drives me crazy, nobody asks what they're actually invested in. What are they underwriting? So those questions, you've got to ask them. And if you look under the hood, you know, today was a great example. One of the biggest alternative managers had published their report. Blackstone.
Yeah.
Did you see the results?
I did. Phenomenal. I'm a shareholder.
So Blackstone's private credit business alone was up almost 13%. Private equity also 13% over the last 12 months. So doing well despite all the cockroach fears. So I had sent you that chart over there
Blackstone
too.
went down 4% today.
Gives a shit.
You know, actually all year long, these managers have been reporting record assets. And oh
Sorry.
boy, that laugh.
All right. That was Ben. All right, guys, they're doing the show before we start the show.
Well, let's get started.
I just wanted to, because
Well,
I want you to have the mic. It's enough of me.
3 claps coming in.
Wait, do you feel like you've spent the last week defending private credit?
Not a little bit. I don't
have.
I feel like I have been, and I don't. How did this happen?
Episode
How did you
214.
become?
Today's show is sponsored by Public. Public is the investing platform for those who take it seriously. You can build a multi-asset portfolio of stocks, bonds, options, crypto, and more.
You can also access industry-leading yields like the 3.8% APY you can earn on your cash with no fees and minimums. But what sets Public apart? AI isn't just a feature, it's woven into the entire experience.
From portfolio insights to earnings call recaps, Public gives you smarter context at every touch point. Plus, earn an uncapped 1% match when you transfer your portfolio, including IRA transfers, rollovers, and even contributions.
Fund your account in 5 minutes or less. Paid for by Public Investing. Full disclosures in the podcast description.
How did you become?
I was the first person to say it's bullshit, and now I'm defending it?
All right, ladies and gentlemen, welcome to the Joe Rogan Experience. My name is Downtown Josh Brown. Today is going to be one of the most epic episodes we have ever done. I could not be more excited. We have in the house John, Duncan, Nicole, Rob, the Compound crew. In addition, joining us today, you know him, you love him from several other shows on this network, and anytime he joins us in person, it's a barrel of monkeys. Ladies and gentlemen, Ben Carlson. I don't have a bio written for you.
Star of Broken Arrow and
This
several
guy.
other 90s
Speaks for
action classics.
himself.
Ben is a collegiate football star. Well, you are.
I flamed out in high school.
Flamed. All right, that was high school.
That was high school?
I played in college for a couple years, but it didn't happen. I was too busy partying.
All right. More importantly, Ben is the head of institutional asset management here at Ritholtz Wealth. He is the author of A Wealth of Common Sense. He is the co-host of Animal Spirits with Michael Batnick, and just an all-around gem of a human being. Welcome back, Ben. So happy you're here. And first-time guest. She was, in my opinion, one of the best reporters covering high finance. That's what I call it. Like the upper echelons of finance.
What happened to finance?
No. Yeah, high finance.
I mean, that's your beat.
Finance.
You changed him.
I went with finance.
You have interviewed, before I even say your name, you have interviewed like every impressive person on Wall Street. You would agree with that?
And even some non-impressive ones.
Sure. Sure, that's true too. Sonali Basak is the Chief Investment Strategist for iCapital, responsible for developing market views and research. Prior to joining iCapital, Sonali anchored Bloomberg television show Open Interest while serving as the network's chief global finance correspondent. Welcome to the show. You happy to be here?
I am so excited to be here. Long-time listener, long-time fan, first-time guest, though.
Thank you. All right. My first question, how dare you defend private credit? No. All right. So this is going to be a show that's fairly focused on private equity, private credit, clearing up some of the misconceptions that I have been spreading in the media. And no, what we want to do is get to the bottom of what somebody who is very connected within this world has to say. I know you've probably spent the last 2 or 3 weeks speaking to people at a very high level about this, both investors and fund managers and corporate executives.
Yeah, we've been speaking to people about it, but we've also been doing a lot of research because
Okay.
we wanted to be so clear about what is and what isn't.
Okay.
And it's funny because private credit in particular, we were joking around, Batnick and I, just a second ago about how you were getting pitches for private credit funds for years now. And most of my career at Bloomberg was very much around the private markets because that's where so much of the activity was moving. So similarly, you couldn't avoid it. So where are we now? It's grown so meaningfully.
So let's start there. Like, how much are we all about to lose?
Well, we did this analysis. You shared it. I have one bone to pick, but I'll pick it later.
Okay, good.
And so, because I know you like a little spiciness. And so, if you look at the exposure across the business development corp universe, this is the private credit universe you'd really look at. Did you see how small the actual exposure was to 2 bankruptcies?
Yeah.
Tricolor was 0.
Well,
Not only small, but so dispersed that
Yes.
no one player is really affected at all,
Right.
other than Jeffries.
we looked at more than 165 BDCs,
Yeah.
and just over a dozen had any exposure at all. And most of the exposure within those funds was 0.05%.
Can we back up and tell the audience what we're talking about? When you say exposure to first brands, for people that aren't paying very close attention, what's like the synopsis of why all of a sudden everybody's worried about this?
So there's 2 companies in a row, First Band and Tricolor, that face bankruptcy. By the way, I would actually argue for different reasons. There was a third company that no one talks about, the Primalend company, right? But because it wasn't tied to private credit, no one talked about it, right? Or because it didn't have a private credit
Not
exposure.
salacious enough.
Exactly. The
Okay.
private credit world draws a lot of questions and attention. So
Okay.
when they went bankrupt, we did see losses tied to banks and then a lot of questions around how exposed banks were to private credit firms because you saw those types of losses within these 2, what Jamie Dimon is calling cockroaches, what people have heard for the last couple of weeks, what people are calling the idiosyncratic risks tied to certain private credit. But really, this was a banking problem, ultimately, at the end of the day. These were bank lines that at the end of the day.
I want to be clear also, in one of these cases, someone is alleging fraud,
Yes.
which is not the same thing as quote unquote reckless lending. It's its own. Fraud is just a part of, unfortunately, it's a risk that every financial institution faces.
But even beyond that, there were a lot of questions about loans that were not disclosed to investors among those firms, right? Fraud. But, was there diligence enough? Was there not enough diligence? This is a big question among the firms that were exposed to each of those companies.
Don't you think that this is actually a positive for the industry, though? Because people wouldn't have talked about this stuff a few years ago. Now, I think it's just going to be more transparency. I think in the end, that's a good thing.
Yeah.
Right?
I couldn't agree more because we were saying a little earlier, if you are invested in a public market manager, you are looking at their holdings. You're looking at what they're invested in. You are asking about track records. Why wouldn't you do the same thing for private credit? If you call up your manager, I did it throughout the last 2 weeks. I called a bunch of managers and I said, what are you holding? What are you holding and how sensitive is it to the broader economy?
You have the ability to do that. Everyone else doesn't.
The thing that's really interesting about private credit now, because it's opening up to a broader market of individual investors, you are seeing more managers be more and more clear with as many advisors that they could be. Really open the doors to the ability to
I agree with
have
that.
conversations.
But I also want to point out these things don't have CUSIPs. This is the fundamental difference. So when you own a public bond fund,
Yeah.
the manager is buying all sorts of bonds, all sorts of loans in some cases, and for the most part, they tend to have a CUSIP, which means an end investor can look these things up, which is way more transparency than by definition you would get from private credit, from direct lending. There's no way to know what anything's worth until the manager files and says, here is the mark. This is what we think it's worth.
But don't you think it's interesting? You know, there was a story on Bloomberg today that's consistent with what we're seeing. As these products become much more available, these investments become more available, you're all of a sudden seeing, you know, what was impossible a few years ago, possible now. Now we have monthly reporting from many funds, for example. And so that transparency, it has to increase as availability increases. But with that said, like, let's talk about just private credit for a second. Shouldn't we just take a big step back here and say, why are we even talking about this? If you think about it, why is it that I have spent so much time on private credit? It's because so much of my career was after the financial crisis. After the financial crisis, regulations really hamstrung the banks in certain areas. But then there's two other moments, arguably, that really accelerated this. COVID. When the banking system froze up in a lot of ways during COVID, it was actually private credit that moved a lot faster into many parts of the economy. You
Because people still needed loans.
Totally.
Yeah.
And so that was one thing. And then when Silicon Valley Bank happened, right, you had seen that kind of regional banking crisis of 2023. And that was another big moment for private credit to really expand its wings in a massive way because, again, you saw the banking system freeze up in certain ways, especially among smaller and medium-sized lenders. So private credit firms started to backstop many of those lenders and become what is now a more critical lifeblood to the American economy than it was a decade ago.
So you're still relatively new to the space. I'm curious, like, what you've learned being on the inside now that we don't see from the outside.
I actually, the chart that I sent you of returns, right? I think a lot of people are asking.
Let's put that up.
Yeah.
We have it?
John has it.
Yeah,
Okay.
It's really, really interesting chart here. And what you're seeing is that you have double-digit returns in many parts of the private markets. I thought this was the most clarity that I
Manager
could.
selection has been an important driver of return outcomes and alternatives.
We're looking at dispersion, and I think Sonali, I don't want to speak for you. What's your point? Because I think I know what it is, but you go.
So a lot of people talk about volatility. I don't think volatility is the problem. I think dispersion is the problem. And if you're not in the better funds, if you're not doing the diligence that many people, as you were saying, Ben, are not doing, by the way, then you're not getting what is possible from this industry, and a lot is possible. Remember, this is also an asset class that institutions were more privy to than individual investors. And we had a great, I pulled this up for you, Josh Brown. You were asking how big of an opportunity the RIA channel is for alternatives. If you are an RIA with assets above 500 million, you could have, they have had much more exposure to alts. Makes sense. You might have bigger clients in that book and more money than to put aside to alts. You used to have bigger minimum ticket sizes, but now you could invest $25,000 in an alternative fund with a fair degree of, this is a whole other topic we should get into, liquidity, right? And
well,
so
I think that's the biggest tip. That's why we're never going to have a plane crash in private markets, because like, let's say this really was, it would be a death by 1,000 cuts because the investors can't panic. Right? You can't get out of it quickly.
How would you panic as a private credit investor? You would have to buy CDS against a basket of the loans that you're on the hook.
So because of the
loans that
illiquid
you've
nature
made.
of the
Right.
funds, like that would make it worse if there was a credit problem and everyone said, all right, get me out now. You can't do that. You literally can't because of the way the funds are structured.
So, John,
so just like a little bit of nuance there. We saw a small version, some would say, if the people that said this is a canary in the coal mine ended up being wrong. But we saw an episode where BlackRock has a semi-liquid.
Blackstone
BREIT. Semi-liquid. And Blackstone had to gate redemptions because the alternative is allow people to have their money back and sell things at a depressed valuation.
Wait, hang on.
And that's not good for anyone if the portfolio is forced to liquidate things at prices that they don't want to. So they gated redemptions. Eventually, the redemption requests cooled off, and BREIT is still trading, and it's okay.
But if you go back to that time, it's such an interesting moment, right? Because it actually worked the way it was supposed to work. A gate is only a gate if you're not legal. Like they had limits all of these funds, to Ben's point, have limits on
Right.
how
It's
much.
not full liquidity.
And it's also not a gate. And so to talk about these funds as though they're liquid is a big mistake
No,
too.
Starwood gated, right? Wasn't it Starwood that said there's no more money coming back? People could fact check. I don't want to like spend a
Right. I don't have it right in front
But I
of
thought
me,
it
so I don't want
started.
to speak
All right,
to.
John, chart 10. So we're fast forwarding for a little bit. Here, this was going to be my ultimate take. I have been of the mind that the episode that we just experienced with Tricolor and First Brand, it's not nothing. There is something happening. Is it systemic? I don't think so. I think that it ultimately blows over in a very similar way that BREIT blew over. And guess what? The stress in the real estate market, particularly the office space, which they don't have a ton of exposure to, at least not anymore. This was so much more significant and potentially systemic. Think about the stress in the real estate sector, the actual stress. And here we are a couple of years later, and it's fine.
Batnick, I'm just going to call you on Tuesday nights now and just be like, let's talk about this.
I mean, I think that's where we
Michael's
go.
point, the assets in this,
It's true.
the assets in this fund have been between 50 and 60 billion for the last 2 years straight. And that disruption that everyone said, this is going to be the death knell for these semi-liquid real estate vehicles, turned out not to be true.
Yep.
And to Michael's point, like the hysteria cooled off.
But if there are real losses, though, the clients are going to have to eat them.
Sure.
That's the thing. That's the difference.
But
So
that
here-
goes back to the dispersion chart too.
Right.
It's not that people don't lose money in this asset class, but they also make a lot
So
of money.
those are going to be the stories someday. Is like, look at how terrible this fund did. The people were overpromised, or there's too much leverage, or whatever it was. Those are going to be the stories.
Okay, so
But my comment at the time was, what? You think you can't lose money in a publicly traded REIT? Like, what are we talking
of
about
course.
here?
So BREIT, the returns have not been great over the past couple of years. Yeah, real estate's been challenged, we know. But is it a catastrophe for investors? No. Is it great? No, it's not great. It's basically flat for the last few years. But let's get back to Sonali's chart that she showed in terms of dispersion. Okay, I think this is really important. When you are investing in things with highly idiosyncratic manager access risk, like venture, like growth equity, the dispersion of returns are a mile wide. And if you're not in the top, whatever, decile, quartile, you might as well.
The better managers versus the
You're toast.
run-of-the-mill
You're toast.
managers
Okay,
or the bad managers.
direct lending is the opposite. The industry is making loans. And guess what? Most of the loans get paid back.
So this is an interesting, like I said, in the last week, I've talked to a lot of managers about this. And it's not like, if you're Stan Druckenmiller, right? Stan Druckenmiller is known for big, concentrated bets, right? That is the secret to his success. But those are like 40% returns, right? Venture capital's like that too, but different type of asset. Direct lending, super diversified. There are hundreds and hundreds of loans that are being underwritten such that if one loan were to go bad, it's a typical.
What is the typical position size for one of these funds? I know there's a lot of different funds, but I mean, what is it? 1%, 2%? Like how big are the position sizes in these funds?
Well, let's
typically?
put it this way. When was First Brands, the losses that we saw, like I said, it was 0.05% that was lost for most of these funds.
So who is
0.05.
taking the losses?
So
Is it
it's
the
a half
banks?
of a 1%.
Those are just the
Position.
BDCs.
Okay.
Yeah.
So you'll take in a bankruptcy, you're taking basically a total
Less
loss.
than half, 0.05%.
But, And the
okay.
problem
Like
with
even-
that is
yeah.
that the collateral, the liens were no good because there was fraud.
Yes.
double
that
count,
too.
double counting
But
assets.
even then, how small that was relative to the overall portfolio, that's kind of the point. But with that said, I actually was pulling up an email because I asked our diligence team how they go about picking funds as well. And they said there are two rules. There are two rules when it comes to underwriting: protect capital and
have
don't
fun.
forget. No, definitely not that. Have you ever heard? Well, protect your capital and don't forget rule number one. How do you
Okay.
ever finish a thought, Joshua?
Sorry. That's a Buffett quote.
Yeah.
Rule number one, don't lose money.
Let me give you
rule
another
number two,
one.
don't forget rule number one.
Who is the one that said don't ever hire an optimistic credit manager?
Right.
I like that one too.
So my take is if you look at just rolling returns, not rolling returns, rolling like inflows, the institution has pulled back dramatically because they're good. They're full, right? And the distributions on the private equity side have just not materialized. So they're not really allocating as much there on private credit or equity. And the flows have been replaced by wealth managers. We know the story. It's very transparent. But it's not as if the inflows have triple X'd. So even though I guess my skepticism would say there's so much money coming in that there can't possibly be this many good loans to make, and therefore the underwriting standards have probably come down. There's probably some sloppy behavior, which we're seeing. And it's not going to be, in my estimation, a systemic, holy shit, I can't believe we were so blind to the risk. It'll probably be lower returns. Now, the counterpoint is, well, but it's SOFR plus 6, and that's just kind of what it is. And so if rates come down, returns will come down. But let's say that there's a tick up in defaults, returns will come down too. So fine. So it's not 9 to 11%, it's 7 to 9%.
And again, it depends on the manager, because the one we were talking about this morning is still double digits, right? But with that said, yes, you're right. There is an element here. I call them tourists. There are a lot of people who have entered this space that don't know what they're doing. That's for sure, right? And why do I believe that?
Stop subtweeting Michael.
Is that?
That's
Oh
too
my
much.
God!
Right.
You used to be my favorite.
I have
Am
a fund. I have a
switching
private credit
teams?
fund taking investors now.
Well, the thing about the tourists here is that we haven't seen a real market cycle here since 2008, not to a severe degree. And so a lot of people who are entering the industry have not experienced that pain. And, a lot of people, when they look at their managers, say, okay, well, what kind of pain have you experienced and have you navigated it? To the point you were making, Ben, on it's not just the ability to withstand pain in the market. The bigger managers, because of scale, there is a benefit, right? If you have management teams and big teams that can work with the portfolio companies, you're also at greater protection of even making it to a workout. And if you make it to a workout, by the way, a lot of these people have been through distress cycles before. They know how to work those.
For the listener,
out.
the workout is, all right, we can't actually make these payments as currently structured. What else can we do so that the underlying company survives? And then the lender has all the incentive in the world. And a lot of times these are bilateral things. It's not a syndicated loan where it just gets adjudicated in court and there's nothing you can do about it. These are like phone calls between people who trust each other.
When were we in Charlotte with Cam Harvey? Years
23.
ago. Okay. So in 23, I was talking to Cam, and this is back when I was like, why am I getting several emails, a dozen a week from private credit managers? And I spoke to Cam and I said, does this worry you at all? And I don't think he's not known as a pessimist, but he's a risk guy, right? And he was like, no. And I said, really? Tell me more. And he said, well, because these loans were otherwise syndicated by banks, and there was a million different investors and knife fights galore and lawsuits. Like, I'd much rather this go to, I didn't say Blackstone per se, but I'd much rather the risk be in the hand of a single operator that can negotiate with these companies and work it out. And so there's been a lot of talk about this payment in kind stuff. Oh, it's all just payment in kind. They're just adding to the end of the loan. They're extended it because they can't pay. And if you look at the data, that's actually just not happening. And if it were, I would be sharing it and people would be talking about it, but it's not. John, can you throw up chart 2? So this is from Houlihan Lokey. And next chart, please. I'm sorry. Chart 3. We're just talking stories without fundamentals and data. And look at the top chart. Payment in kind.
Let's just slow down. Define for the
did.
No,
so
but what does that mean? What does that mean for somebody that's
just because
investing
you weren't
in the
listening? So payment in kind is when the payment is missed and it is added to the end of the loan. It makes the principal payment
in
bigger
lieu of making a payment
Correct.
today. We'll just give you more money.
Yes.
We'll lend you even more money,
Yes.
and you'll owe us later.
So that is the buzzword that people keep talking about.
That's what the Financial Times looks at and says, this will end badly.
Okay, but look at the data, please. So payment in kind as a % of total interest income, it's steady. And if you look at non-accrual investments, which are borrowers that missed a payment, there's nothing there.
And I've got to say, I've tried to look at this in so many ways and stress test all these ideas because, not only has this remained steady, when you look at the markets, are you more worried at this juncture, honestly, about public credit or private credit?
Private credit.
Why? Credit spreads are
Well, hang on.
enormously,
But don't
enormously
the
tight right
yields
now.
have to come down though? If there's that many lenders out, Josh said, well, it's the SOFR plus whatever. Don't they have to come down if there's that much competition for the loans?
That's what I'm worried about.
Okay, let me address this too. There's two things going on. The traditional way private credit used to be defined was direct lending. This was, levered loans by and large. That's estimated to be a $1.7 trillion industry. Broadly syndicated loans are actually less than that.
What's the difference
now.
between those two? I thought they're kind of the same thing.
Bilateral versus a syndicate
Right.
where there's a million lenders and everyone has a tiny slice.
Levered loans and bank loans aren't the same thing?
So broadly syndicated loans, levered loans are in the same bucket, but direct lending versus BSL.
Okay,
broadly syndicated
got it.
loans, that's what I'm talking about. Direct lending is now a bigger, by many estimates, industry than broadly syndicated loans. So it's kind of, how much bigger can it really get when they're kind of the same type of borrower? We'll see. The high yield market is, different estimates, but just a little bigger, 2.6 trillion. So where now has private credit been going next? Why is it growing so much? It's not all direct lending
Data
anymore.
centers.
There's a lot of data centers, which are absolutely
great. More exposure to
fascinating.
AI.
I know.
That's what everyone's missing in their portfolio.
But also
is more
asset-backed.
AI exposure.
There's so many funky things, right? Asset-backed lending, music royalties. There's consumer finance, which is more weighted to the credit cycle. And so I think the industry is evolving in different ways. You're just seeing it's just lending. It's just lending.
Direct lending is Ares raises a fund.
Yeah.
They raise $10 billion. Mid-sized companies that are not going to issue bonds in the public market go to Ares and say, we have a contract to supply X number of gigawatts of electricity to this AI data center. Here's the contract. Meta is paying. We know it's money good. Basically, it's almost like factoring.
But let's go to the data center thing for a
So
second.
wait. So Ares makes that loan
Yes.
in their fund.
Yes.
I'm comfortable with that because it's Ares on the hook for it.
I thought you hated private markets.
He's
What
talking
happened
himself
here?
into it.
No. I want to point this out. I think it's important. A lot of people are making the comparison, myself included, to the mortgage bond, the mortgage bond era.
Interesting.
The difference between this and that, this actually seems safer to me because in the mortgage bond era, nobody knew who owned what. It was syndicated to death and tranched.
And it was backed by the strawberry
Yes.
farmer who had 8 houses.
Right.
This is backed by Meta.
It's
It's not the same.
I'm saying something very constructive here, which is that I feel pretty confident the guys running Blue Owl and Ares and Apollo, they're not complete insane maniacs that are just randomly spitting money at lending opportunities and hoping for the best.
And they all have seen a credit cycle,
Of course.
right?
These guys all came out of
like Drexel.
Yeah, they've seen it all.
Yeah.
So I'm comfortable with that aspect of it. This is what I've been saying. They're not the only players in the market.
Yeah.
That's one.
Mm-hmm.
Now you have a second tier.
Yeah, because those big firms, they can short up.
But wait,
they have
hold
so
on,
much
hold
money.
on.
And they're not the ones pitching Michael.
But wait, okay, so this is a very important point. So all of this bullshit in my inbox, these funds are nonsense, right? Even if it's like a third tier asset manager that we know, no chance, buddy. Sorry, not gonna happen. But the Blackstone, Ares, KKR, Carlyle's of the world, there is only like 6 of them that can make this $5 billion loan. So they're not fighting for scraps with all of these 4th tier entrants.
Right.
They're gonna get smoked, the lower ones. I'm pretty sure to Josh's point that the contracts with Oracle, at least for now, they're gonna be okay.
The contracts that you have with the hyperscalers are some of the most interesting ones. And why? One is because those are between 15 and 30-year loans. They are so long. And yes, if you're worried about public market valuations of those kinds of companies, that's one thing. They have to pay their lease, right? That needs to happen. And
Why are those loans so long?
Because they're leases. They're data center leases. That's where I think that the confusion around what's actually happening here. You're talking about what has traditionally been known as direct lending and private credit. Yes, fine. But the way the industry is going is also these massive data center leases too, that are very long leases. And so they're not just that. Some of these are also because they're rent, right? It's adjusted to inflation. So the cash flows grow every year. That's the other pretty interesting.
All right, so now let me tell you though, the second half of what I'm saying. This is what I'm worried about.
Sure.
And I have firsthand knowledge of this.
Okay.
Because
He's very old.
No.
Do you lose money in a private credit fund?
No.
Yeah, show me on the dollar with a private credit touchdown.
No. But I have an analog that I think is very apropos of I actually think my firsthand experience could be emblematic of what's happening all over the country, maybe all over the world. In my industry,
yes.
The wealth management industry,
yes.
Every single day, there's another article in the trades about a private equity deal.
That's the bubble.
Okay.
Let me hold on.
Yep.
For a firm that I already know is a piece of shit. Okay? Every day, not every week, every day. They are taking other people's money. They are buying firms that have no real enterprise value at absurd multiples, 20 times cash flow. They are retiring the boomer who started the firm 20 years ago, and they're basically smashing this acquisition together with a whole pile of firms just like that and they're calling it a business. In reality, they're buying salespeople and those salespeople's relationships with their clients, and they're counting on the fact that they're only going to have to sue a few of these people who try to leave. These are horrendous.
Right.
Horrendous. Now,
I
I
mean,
know this
Not
firsthand.
everything, again, dispersion, but to your
Of course,
point.
not everything. But I have to overgeneralize because the question is, why is this happening? I will tell you why. All of these funds have raised so much money from investors, they have to do something. And all of the best assets are already spoken for or not for sale because they're good assets. So what's left?
Like us.
What's left is making mediocre investments in mediocre companies at bad valuations, competing with 50 other funds. There's just no way on the equity side that that's good business. How could it not be similar on the credit side? It's the same firms.
Whoa.
No, not. First of all, it's actually not the same firms often because, what's grabbing headlines, sometimes it is. When it's the same firms, you're looking at a big buyout and maybe the direct lender is exposed, but they're downside protected, right? That's another aspect of this.
Why? Because they're at the top of the capital.
It's loans
Right,
versus
exactly.
equity.
Yeah, that's a big difference.
It's not even close to the
But
same
if
thing.
it's the same industry competitive dynamics, if there are
But they would have to
thousands
go
of
bankrupt.
players
Loans
Lose.
versus equity. Loans versus equity.
But don't you see?
Yeah, I do
it's
see.
the same competitive dynamics.
I
No,
understand.
but
If
they
we
would
don't put
have
this
to go
money to work,
bankrupt,
we're gonna
right?
lose. We're gonna lose the AUM.
I understand, but to Sonali's point earlier, the equity dispersions of managers, obviously I agree with you with what we're seeing in our industry. I don't want to invest in those
But
shitty
don't you
companies.
think every industry is the same thing?
No,
But loans and equity, they're so different.
That is we'll get back to that because that is the most important part of this. But on private equity, to the point that you're making, it's even beyond the bad companies being bought. It's the fact that you have, they call it the DPI issue, right? Have you heard of this a lot? It's basically that private equity firms have been sitting on
they're
assets.
not giving investors money back.
They're not giving investors money back. And so when people say that, they just mean that it's they're stuck. It's a complete clog right now. Not complete. It's starting to open up. You saw that in the results.
Well, because valuations got so silly. There's no more buyers.
And what's happened? This is the problem. As it pertains to private credit, there is a controversial thing going on right now in the way that people are keeping companies going via debt just because they can't exit in the private equity universe. So yes, I don't disagree with you. But if you are a credit firm, remember the risk profile is this. Josh Brown, I'm going to lend you money. You're not that good of a borrower. It comes to me at 15% to 20% because you're not a good borrower. And so but what I'm betting is you're not going to default. What I'm betting is you're not going to go bankrupt on me. You're not going to miss your payments. So it has to be a much worse of a borrower than, the competitive dynamics are bad. Because if the competitive dynamics are bad, then your equity valuation just sucks.
So the
right?
equity dumb schmucks that are investing in these companies at stupid valuations, they're not going to get money because there's no growth.
It is the equity holders'
I may not intend to default, but in an economic downturn, I know we haven't had one in a very long time.
That's the point. We're not going to know any of this until there's a recession.
Some companies, just the cash flow isn't there to support the loans they've taken out. And the smart thing to do is to default and clean the slate or liquidate. And we just, what Ben's saying is what I think, which is that, okay, we don't have a dry run.
Yeah.
We don't have recessions anymore, though. Sorry.
We had a 7-minute recession 5 years ago.
It's been 50. That's the thing.
Ending,
All these systemic risks we're always talking about, we're never going to know until we get another recession.
How could you? You can't do a rehearsal.
Yeah, right.
So that's my only point is, and now the industry has made more loans than they've ever made. The dollar amounts have gone up, and the amount of people in this ecosystem borrowing from direct lenders has gone up. And look, there will be losses in public credit too.
Yeah, I was about to say, everything you're saying is obviously true.
Yeah.
And when the tide comes out, people eat shit.
Me and him were talking about this.
But here's the difference. Wait, no, this is really important. Here's the difference. As a financial advisor, I call my clients and I say, the economy looks really bad. You got auto companies spitting the bit. You got banks reporting losses. You got credit card companies.
Our pets are falling off.
Hold on. Right? Let's sell and go to cash. I can do that in HYG whenever the I want. I can't do that.
You're saying that's good. That's not all good. That people can panic?
Not panic, decide that they don't want to take as much risk in the credit market.
After deep losses.
I can't do that. Not after, maybe in the early innings. You don't know how long that goes on for.
To me, that's like the least offensive part of it.
But also remember, this goes
The
back
I've been around a long time. Do you understand? I drank out of glass Snapple bottles. Do you understand this?
I
That's
was
how
a mega
long I've been
plaza, too.
around. I'm just saying, as an advisor, if you say to a client, we're down in this bond fund because some of the credits are blowing up and we're just going to take a little bit less risk, we're going to trim. You can't do that.
Dude, when
But
in a
tell me
private
this.
vehicle.
What are you going to sell first? If things are really going poorly,
Stocks.
Equity.
you sell
Stocks
your
first.
equities first.
No, but you're right that people are going to change their allocation preferences.
They're
lot of
gonna
them
want more of
afterwards.
this. Don't you see that?
No
that
way.
is
Yes,
what-
they
this is
are.
what-
No, there's going to be a lot of people who
Just
say,
Smoking crack.
That just happened in 2022 when people got their asses kicked
That's true.
because their bonds duration killed them. That's why they flooded into the floating rate nature of private credit.
And also
they wanted
Floating rate
more.
good. Floating rate good. Illiquid floating rate not as good.
Wait, but that's
what
that's
it
been the
is.
double-digit returns. But also even beyond
I
that,
get it. I
but
get it.
2020 and 2023, when we were talking about when credit ultimately people didn't feel so good about it then, right? You still saw private credit being able to step in this massive way and buy things. That's when the things are cheapest. Those are the best investments
Can we
that they
all
could possibly
agree?
make.
Can we all agree that investors prize liquidity in a crisis?
Yes.
Yes.
We can
Okay.
all agree there.
Well,
We
what
can
you're
absolutely all agree
saying
there.
is the 180 degree opposite of that.
I'm saying that if you have a normal, responsible portfolio and 10% of your portfolio is illiquid, you're going to be fine.
But also, how much of your portfolios are in cash right now? Because what,
100%. I'm super bearish.
Well, but like the average RAA has what I've heard anywhere.
The average RIA holds 2% aside, mostly so they can bill their clients.
Wait, can I
Just
just say,
2%?
but Sonali,
Yeah.
one other thing that we mentioned that we glossed over on the where would you rather be, private credit, public credit? Again, not to be the defender here, but on the private side, what you are getting in exchange for the illiquidity
Mhm.
is a relatively constant spread over SOFR. 500, 600, whatever
Which
it is.
is meaningful.
Okay.
That's the source
in
of returns.
public markets right now, and
Right.
granted, you could say that the quality in HYG is higher than it used to be because all the bullshit is going to private direct lending. Fine, I'll grant you that. But right now, credit spreads are so tight in public credit. Like, I don't know. Is that better? Why is that better?
Right. But in general, in an economic downturn,
Yeah.
people very highly value. And I'm going to tell you something about the financial advice business because there was a time where we were all told hedge funds, got to be in hedge funds. Hedge funds avoided the dot-com blow up. Hedge funds made money in the lost decade for stocks. Hedge funds could play the market.
But there's a lesson
Hold
here.
on.
There's a huge lesson in that.
And then the illiquidity of a lot of those hedge funds had private market assets.
yeah.
They had to side pocket them. You couldn't get, and that pissed people off. Even if the returns 5 years later were good, it was beside the point. When things are not going well, people really value the ability to reach in and pull cash out for whatever
I
reason.
don't disagree by any stretch of the imagination.
Well,
But-
advisors who have very illiquid portfolios for their clients,
Right.
unfortunately, are going to have a lot of difficult conversations if we ever have a
Well,
recession
guess what?
again.
Those
You're
clients
not-
will be our clients
Well,
eventually
it
if they do that.
It shouldn't be. You should have a reasonable amount of alts in your portfolio that are not. It's not. You have to still have a liquid part of your. You know, it's interesting. Goldman came out with a survey the other day, and a fifth of the respondents in the survey were holding. Actually, no. Out of the survey, 1/5 of all the total assets that were surveyed for were in cash. A fifth still today.
When you
Okay.
say in cash, like all in cash? What do you mean?
So a fifth of the total portfolios that, right? So like
Morgan
of
Stanley
all-
said that on one of their calls
That's what I'm
recently.
saying.
20% of their, yeah.
So if you look at the wealth community writ large, there's a lot of money in cash. So
Mhm.
the liquidity question has clearly been on everybody's mind, especially at these levels. You know, where are we in the market? So on and so
I
forth.
don't
Josh is
hate-
right. Josh is right. If you overdid it on the private side with your clients and they're 40,
It's
50%,
tough.
you are fired, you dumb asshole.
I don't
You're
hate.
fired.
I don't hate a barbell.
You're allowed to curse on here?
We can do whatever we want. I don't hate a barbell of I'm 10% cash and I'm 10% illiquid, high yielding assets, and I can make sense of that because it's a total portfolio approach. It's not what I
Well,
personally
Michael's right.
recommend.
That's an advisor problem, not a client problem.
It's an advisor problem. Yeah, no, but it's a real one.
yeah.
It is a real problem. But that's the thing. Thinking about it from a total portfolio is the only way to think about it.
Yes.
Right? You can't just like dump all of your assets into
But
illiquid.
people do. But here's the problem, though. People, it's called mental accounting. People do this all the time. A client looks at their portfolio, they have a conversation with the advisor. 80% of the portfolio is going up, 20% is going down. What do you think the client has questions on?
Yeah.
Should we still own this?
Yeah, 100%.
What are we doing with this? Do you still like this as much as you liked it when you told me to buy it? They'll fixate on the part that's down. Now, they shouldn't, because that's probably the part that's about to outperform. I'm just telling you the difference between data and how things actually go when you're helping people with their money.
If things are going wrong, think about it this way. Let's just draw out that scenario, because 2008 and the market structure today for private assets are different. Yes, if I'm holding a hedge fund where you think they're in a bunch of liquid stuff and turns out they're not, that sucks. That totally sucks. It's also not what they really sold you, right? Yeah. But now what you're looking at is a market that's meant to be illiquid, right? And so it's like, wait, okay, to your point, I know I can't pull this money out. And when things do go bad, it's more likely that those public assets have been facing that decline than your private credit, which is, supposed to be less volatile than what's happening in the public markets. And not because of liquidity.
But you know what I'm bullish on for that reason? I think the most popular category in this space is going to be secondaries.
Yeah, that's huge.
Because that's how you take advantage of all the problems I'm pointing out is you're invested in a fund that's waiting for people to choke. Mm-hmm. And then when those other funds are choking on assets and have to sell things, the secondary fund is there to get that discount.
Are you a distressed investor?
I might be. Holy shit. I'm definitely distressed.
The thing is, there's going to be so many.
Distressed.
I think so. There's going to be so many overreactions in the next recession.
Oh, hell yeah.
Right?
That's no matter what.
It's been so long since we've had a real one that wasn't shored up immediately. I think the knock-on effects of whatever the next recession happen is going to be enormous.
Well, let me ask you a question. We were talking so much about privates. To your point on total portfolio, how vulnerable is the stock market to that?
It'll be fine.
Very.
Oh yeah.
Very.
Right? What does a recession people are saying bubble this, bubble that, but realistically speaking, if something actually goes wrong with the macro.
Yeah, if the loans go bad, could you imagine what the equity is going to look like? Could you even imagine?
It'll be way worse.
So I want to just, I know we've gone long, but I want to, we can't not talk about the banks, especially because Moody's just put out a big report yesterday that is really important. And they talk about the big picture. And I would agree with everything that they said here in terms of this. Risk is rising, especially for smaller banks. They talk about growth and competition. They said concentration risk is a concern with banks specifically. The true risk can be hard to assess. Of course, we all know that. And then lastly, transparency in bank loans exposure is improving, but new light exposes gaps. So they have these great charts that I want to talk about. They showed that banks help. Ironically, Jamie Dimon. I mean, there's a love-hate relationship. So banks.
This is so wrong, though. The data's wrong.
Oh, go ahead, please.
Sorry, this kills me because they said there's $300 billion.
Moody's is never wrong about anything.
No comment.
Say more.
This data is not, maybe not wrong, but at least a little misleading for this topic. So $96 billion is really what's in private debt funds. They're saying it's $300 billion. What they're counting for.
No, that's percent growth.
Well, no, but in total, what they're counting, it's percent growth, but what they're counting is up to $300 billion in loans outstanding. That happened to be the same for no reason. But it's actually, when you look at the total, that's the growth off of a almost non-existent base that you're looking at. And then on top of that, it's actually $96 billion, not $300 billion. And out of the entire universe of a non-bank financial credit, which is getting bigger, the private credit is only 4% of that.
So this will 4%. Bother you less. So is this a better... This is better representation. The NDFI on the bottom is
it kind of, but the NDFI is a really
non-deposit
broad
financial
category.
institution or shadow bank.
That is like online lenders. That is like all sorts of specialty lenders. That you name it.
All right, fine. Forget that bullshit.
Pension
Here's the important part. Here's the important part. John, chart 9. I'm gonna try one more time. All right, the rise of private credit. So Bloomberg took the data from Moody's. So tell me if this is wrong too. It might be. So this is the amount of loans in private credit from the banks. And J.P. Morgan.
They found a way around Dodd-Frank.
Yes. So Matt Levine wrote about this yesterday.
Jamie Dimon's eating chocolate cockroaches.
But look, Wells Fargo, $60 billion in exposure to private debt firms.
Sure.
J.P. Morgan, they're not making the loans, but they're making the loans to the people that are making the loans.
They're lending the money to the lenders.
Exactly.
It's genius.
Exactly.
But they've always done that, right?
I know.
J.P. Morgan's biggest customer is what? Like mostly regional banks, right? How many do they bank? 4,000 of them?
Yes.
Right?
That's their business.
And so when you look at this number with what I just said, that it's the private credit definition that they gave is a little misleading because it's those online lenders, it's the specialty lenders, it's all sorts of lenders. So it doesn't actually show what their private credit exposure is here. It's a lot less than that. And, you think about it, people are talking about JP Morgan's private credit exposure, but like they also just increased their provisions for loan losses to the entire economy, right? That they have underwriting that suggests that loans, just regular way consumer loans, could start to sour a little bit.
What do you think of this, though? Nothing's happened yet, and people are this vigilant. Is that a good thing or a bad thing?
You know, I'm with Ben. I like it.
We don't have delinquencies in real life, and people are like, suspect everyone.
Let's be honest. If this really were systemic risk, everyone's getting bailed out. Come on.
Well, that's true. That's true too. That's the funny part is that no one will actually have any consequences.
Yeah, it'll be fine.
But do you feel like that's a good sign that we're all like, Jamie Dimon, we're scouring all of our books? That's kind of good.
It's very good.
That we're doing that now before there are actual losses.
Never hire an optimistic credit fund
All right,
manager,
I like that.
right? Like you
Next
should
topic.
Yeah.
BDCs.
Yeah.
How do you sleep? No, I'm just kidding. I wrote it. So I know you wanted to take issue with one of the things I wrote. I wrote about BDCs.
You called me biased.
Not to, well,
I'm
of
coming
course you
after
are.
you.
I'm biased too. wait. Sonali, I'm biased. I'm biased toward the stock market. So we all have our.
Fair enough.
Okay. I wrote about BDCs because I think they are the exposed part of the wound. That if there is a wound, in the way that they behave. People are worried about two things with BDCs. The first is very banal. As interest rates come down, obviously, the yields that these companies are able to pay have to come down with them. Nobody should be alarmed by that. That's the way interest rates work. So we know that dividend distributions will come down, and these stocks are selling off in that expectation. We had the first rate cut of the cycle in September. Maybe we get another one in a month or two. Okay, no problem. But then the second part of that is, oh, wait a minute, there's fraud at with some of these loans. How much more fraud might there? Okay, what if there's 3? What if there's 4? Zions Bank came out and said they're suing somebody.
There's
they lended money to.
There's definitely more than 4.
We know there's going to be more than 2. I'm not saying it has to be 2,000. But a lot of the things people are saying in defense of the BDCs were the same things that they were saying in defense of the mortgage funds 15 years ago. And I know because I was there. And it's not terribly different in terms of rhetoric. The reality might be different. What do you make of the panic, minor panic, that we saw in the publicly traded BDCs? And would you agree that this is a better gauge of credit risk right now than what we would traditionally look at, which would be junk spreads relative to treasuries?
There's such a massive difference, I think, between between credit risk and between spread compression and credit risk, right? Credit risk, we're talking about whether you're lending to a worthy borrower. Spread compression, you're saying returns are going to come down over time. Okay, fine, maybe. But if returns come down in private credit to the point Michael Batnick was just making, it would come down in public credit too, and the spread for private would still be higher than that. So the wound, which wound are we talking about, I think, is what my question is, right?
I'm not worried about spread compression. I don't think that's an emergency.
And so are you worried about widespread fraud?
I'm worried about the rush to put money to work.
Okay.
That we all have to acknowledge has been a big part of this era. What are the ramifications that will stem from that if and when we have a credit cycle?
So Josh, right, the only question that I have for private credit managers as we talk to them is, what if you get $10 billion in funds tomorrow? How quickly do you deploy it and how? What are your controls? Is it just cash in, got to make loans, cash in, because it can't possibly work that way. And if it does, and people are doing business that way, and I know a lot of people are, you're going to be in trouble.
Yeah, and not just for credit, for private equity too. The biggest mistake many managers made the last few years is they made all of these acquisitions in 2021 that doesn't look so pretty today. Right. You know, things felt really good, so people put a lot of money to work, and look at where we are now. But you know, I don't think if we saw a scenario in which Ben was talking about, which is a widespread recession, who's safe in that scenario? Like, what is safe?
You're
in
right.
That scenario?
And nobody in 2021, when the music was playing and all of these giant mega growth funds were investing in these companies and insane valuations, I remember that there was very few people calling it out and saying, this is crazy. And one of them was our friend Howard Linson, who was like, I have cash and I'm not investing because the prices that I keep seeing are stupid.
They spent it too fast.
And when they
Simply.
stop being stupid, I will start investing again. And that's who you want to give your money to in periods of complacency. And there's no doubt that there is too much lending and it's too much, it's too fast.
Hey, I mean, if there's anything to take away from all this, right, is do the damn homework, right? Don't put your money just because there's a promise of something interesting in an industry that's a hot asset class. Do the work and say, okay, what is this actually investing in?
And put it in your 401k, for God's sakes.
I was waiting for that to come up today.
Do you think investors should be biased toward the larger players in the space as a just in case?
Yes.
Because I do. I think brand and size
Scale
and
matters
scale
here.
really matters.
But this
They
here.
matter for a lot of reasons, but not in every asset class, right? Because things like private equity, actually middle market and lower middle market have much more attractive return profiles than you would have in like those large scale buyouts
This
right
is
now.
the opposite. I feel like in venture and with hedge funds, smaller managers tend to do better because scale is the enemy at that
Right.
in that space.
I think with
Here
lending,
it's
it's the opposite.
It's the opposite.
Yeah,
You need scale.
I would agree. I would agree with that.
Okay, so that's so you're asking people to do their homework, due diligence. Most people listening to this who are being
No, I mean
recommended.
like you, like the advisor.
Oh, I'm doing zero. So this is gonna come off as like overly cynical and sardonic, which is right on brand for me. But somebody asked me, "What's your private equity, private credit strategy?" And I said, "I'm just gonna wait for the disappointment and then take everyone's
Do
clients."
you own a house?
Yeah. Is that my private credit strategy?
You own a hard asset. You own a private asset, right? And so what you're asking someone to do in a private fund is to buy assets that you're going to buy hard assets. You could buy infrastructure. You can get into credit.
Sonali, I don't have enough money to be able to buy the things that are private assets that I actually think I would want.
Do you have $25,000?
Yes.
That's
How will that move the needle for me?
But that's what
The thing is, I don't have $1 billion and I can't buy an NFL team. And that's the private asset that I am interested in.
You need a financial planner.
I can't really help you there.
But
I know some athletes.
But that's
get you an intro.
I don't think every market.
Yeah.
I don't think every market makes sense for every person.
That's true.
Okay, so in the private market, the best managers who have access to buy the best assets are not going to be accessible by every investor. That's my point.
That is true. But I would also argue that because there's a lot going on. The operational efficiency is getting better. The documents are getting more fluent to access, and the technology is getting better. The fund structures are changing very meaningfully. The minimums are coming down. That's why we're even talking about this, honestly speaking. It used to be impossible to access many of these types of assets.
Even 10 years ago, wealth managers couldn't do it.
Even 2 years ago, they
I
couldn't
agree
do
with that.
it.
And those are all good things. Anything that you do that makes these things more accessible and makes it so you can actually research them.
And more transparent.
And lowers the fees and adds transparency is unequivocally good.
But that means
unequivocally good.
Lower returns.
Lower returns.
It has to.
It depends. I actually don't agree necessarily on that because these are, just because you open up something to a wider array of investors doesn't mean, like here, 401k plans, that's scale, that's pricing power, and that's net of fees, a better return. Now, I will say this, the liquidity trade-off, that's where the return compression comes in. You're seeing a lot of products come to market that are like, oh yeah, we're private, but we're liquid. You go one level deeper.
Disaster.
Well, but it's also not private. It's blended. So
the more liquid something is, right, by definition, it's not.
It's not liquid. It's not illiquid.
It's not private.
It's not private. And so a lot of these funds are like, okay, well, we're part this and part that. And like really the private allocation is like this big. And yes, you're going to have a trade-off there where you're not getting paid for that illiquidity premium.
Human nature, okay? Just answer me this. If something is an amazing investment, whether it's an asset class or a particular property or a particular whatever, if something's amazing, are billionaires going to let dentists get in? No way, right?
Well, the billionaires, it's funny. Tony James wrote a book about this.
The billionaires
right,
need the
ago.
dentist, though, now.
Yeah, the billionaires need the dentist.
as exit liquidity.
But, dude,
No,
stop.
not
What are you
necessarily.
talking about? Who's saying this is an amazing investment? Private loans do 8 to 10% a year.
No. We're talking now. We
Like, what
switch
are you-
topics. We're talking about private equity now.
Okay.
I'm saying if something is like an incredible opportunity,
Right.
and Mark Cuban buys 20% of it, and someone else buys 20%, and someone else, and all these wealthy, well-connected, famous, brilliant people.
Josh, what team do you want to buy?
Wait.
Just let us know.
And then there's 10% of it left. Why would there be 10% of it left for the public?
Let's put it this way.
Why? Why wouldn't they just
Yeah.
buy
No,
the
you're
rest?
right. You're right. Of course, the best investments are for the ultra wealthy.
And that
Obviously.
will never change.
Never, ever.
So anytime you're democratizing something, you're telling me this is third tier.
First of all, are sports teams always good investments?
Yes. Name one that isn't.
I don't know. It's funny. I once asked Mark Lazary why he got out of the Bucks, right?
Best
Yeah.
trade ever.
Well, he said
He bought it for $400 million and sold it for billions. That's a good enough reason.
But he then went to other kind of more esoteric sports like pickleball, right? Because the return profile was better there. And yes, these are not available to everybody, but I would
Do you know
say
the Jets are probably worth $5 billion?
Oh, I'm so glad you mentioned that. Sorry.
Is that
There
who
is
you want?
no sports franchise
Is
that
that-
goes down in value.
So last night I went to the Knicks game.
but the return rate can slow. That's what I'm saying.
True.
Last
True.
night I went to the Knicks game and I was genuinely thinking about this. What are the Knicks worth? I don't know, 6 billion, 8 billion, 10 billion,
Yeah,
whatever
right.
it is.
15 in real life.
Okay, whatever. Fine. Let's just say it's 10. Oklo's worth like 25 billion. Like all of these like nonsense pre-revenue
Right.
companies are like when you put it into that context, and I know it's apples and computers, like it's not but it is kind of hilarious.
But by the way, I don't think we're that far off from having individual investors being able to be in sports teams too. Because
I
of-
agree.
they're there, private equity is there.
That's what I'm saying.
Yeah.
So actually, the universe of investments is just getting a lot bigger. So I don't disagree that there's exclusive investments that are maintained for the ultra wealthy, but I'm saying the universe of investments that only used to be for the ultra wealthy is now expanding. At a
So
really
I
meaningful
think
rate.
that's good. I do think people should leave room in a portfolio. People who are wealthy.
Did we win you
Hold
over?
on.
I
No.
think the boxing judges
I was
called
already
this one
there.
a tie.
Sonali, I was already there. But I also know. So I'm a firm believer. I'm a firm believer that 90% of everything is shit. That's what I think. Okay.
You know, I will actually agree
So
with you
most
there.
of these investments, they don't have to go bad. I wouldn't say that. I would just say like, do you want to own the fifth best fund in a sector? And you just showed us dispersion is really a big deal in this space. You do not want to own the fifth best manager. You want to own number 1 or 2, or your returns will be radically different. That, from my perspective, I think that's why iCapital has been so successful. People need someone to tell them this is the good one, that's the bad one.
You know, and it's the beauty of my job. And it's so funny because I asked my husband, I'm like, how do I fight with Josh Brown about the bias comment?
We're not. So we agree
I'm
on
like,
we agree on almost everything.
we do. And I would say it's not about, there's no interest in being biased. The interest is same for both of us in being right. Right.
Yeah.
And being able to do as much diligence as humanly possible on behalf of everyone else. Right. That's what I got to do as a journalist. And it's what I get
So
to
my
do
last
now.
question then, is it realistic for somebody who has $200,000 in a 401k to be able to take 25,000 of that and put it into a top tier private equity manager
Wouldn't
or
you
private
think?
credit manager? Do you think that's actually what's going to happen?
I do.
You do.
I
Okay.
think it'll take a minute to get this ironed out properly, but private assets writ large.
Do you think the better managers will make themselves available to inflows
Oh, that's definitely
from a
happening.
401k?
Well, don't
That
They
is
need- they need
1,000.
it.
Yeah, don't they have to? Because
need
if they go into 401ks and it's a disaster, then like that's gonna be really bad. They're gonna have to put some
They'll get-
decent funds forward, don't you think?
Yeah, they'll get kicked off. They'll get kicked out of the plans if they blow up right out of the
Yeah,
gates.
they have to do that. It has to be top tier quality. And also, I mean, the idea of putting assets in a you're holding that for a long time.
Yeah.
That's one of the best possible structures for private assets.
Yeah, so I don't think Schwab and Vanguard will work with terrible firms or dodgy. I agree with that. I do think there will be marquee names in private assets working with the marquee names that manage most of the country's 401ks. So I don't think it's a case where bad product is going to be shoved down people's throats. I guess I just question, it's probably not bad, but is it even good? Will it be materially better than what they could do with low cost index bonds and stocks? I don't know the answer. But that's the question.
You know, a couple months ago, remember, made a lot of news when Goldman came out with their assumptions for where the S&P and 500 is headed in the next 10 years. And just because of valuations where we are today, I mean, that is one of the big problems, right? It's just capital markets assumptions, where we are in valuations and the expected returns over 10, 20, 30, 40 years.
Right. Why we're overpaying public markets, you could overpay in private markets.
Very nice.
But hopefully nobody's overpaying with us, right?
Sonali, you're so good at this. It's scary. I want to thank you so much for coming here and pointing out all of these things that are getting lost in the conversation. Did you have fun on the show?
I love this show. I'm your neighbor. I'll come.
Can we do a
just to be
Rocky
in the
versus
audience.
Apollo for the thumbnail of you two?
we like agree on like 90% of this, I think. I think we both want what's best for the investing public. That's pretty obvious. Yes?
1,000%.
All right.
Optionality and education.
And I think I'm in on secondaries because I like buying other people's pain. I like that.
I'm just going to call him Vulture from
I
now
almost
on.
forgot to mention this. We have to disclose this. We are a shareholder of iCapital.
You are?
So you
technically Michael's your boss. I don't know if you know that.
That's scary.
iCapital.
Go get me a glass of water.
iCapital bought one of our companies, so we have shares in your company.
Look at that.
Well, I'm hoping you're enjoying
don't
that
screw up
whole
our
thing.
My kid 529 is counting
That's
on
why
you.
he's a spokesman for
Exactly.
Yeah, no kidding. I love that you
The truth
threw that at me
the
at the
truth-
end
the
there.
truth comes out.
Would have been nicer to you guys.
All right. So we always end the show asking people what they're looking forward to. And I'd love to hear from you guys. What's hot in your world? What's going on the horizon? What are you excited about? Sonali, you can start.
All I can think about is the CPI print tomorrow. Is that horrible?
Are we even gonna get one?
You and Callie, both.
Yeah.
Callie's excited too.
It's only it's a data starvation for the last 3 weeks.
I guess I'm sort of excited about it too. I think just in general, I think we'll just get one more rate cut at the end of the year, no matter what the CPI print is.
Just one? You think definitely just one, not two?
Maybe more, but I think we're definitely getting one.
Yeah, I would agree. I would agree with that.
What are you excited about? What economic data point can you not sleep until we get?
So I'm excited. This weekend, my son plays 3rd and 4th grade football.
Okay.
In his last game of
Following
the year.
in his old man's footsteps?
He's on the line. He's not like me.
Okay.
They're playing their last game of the year at the Big House in Ann Arbor.
Oh, wow.
It kind of came out the end.
Is Rasnick going to be there?
Yeah, is Jason Rasnick going to have a front row seat for that?
So something about football was my sport. So watching one of my children play football has been like so gratifying for me. It's unbelievable. It's so much fun.
What do you think of the Lions season this year? I thought they'd be better.
They're not bad.
They're good. I just thought they'd be better.
Yeah, but everybody thought losing their coaches.
Ben's from Detroit.
They take a big
Why are you
step
looking at him like
I'm a
he's crazy?
Packers fan, so I think we're not friends.
Okay.
No, wait, they lost their
Across the leg.
offensive and defensive coordinator, and they're still kicking ass.
Yeah. And we have the
They
best
look
running
okay.
back in the league.
Yeah. They look
We've
okay.
never- yeah,
Oh, that guy's freakishly fast too.
Gibbs, yeah.
Yeah. All right. So, but overall, it's not a terrible season. It's just, I guess I thought they'd be more dominant.
Aren't they 4-2? What's their record?
5-2 or something.
No,
That's fine.
they're going to the Super Bowl.
You think so?
Yeah.
Okay. I don't know.
Who's
I don't
better
think-
than them in the NFC? Nobody.
I have very low expectations for the Lions every year.
Grand
so.
Rapids Hedge.
Yeah.
All right.
When were
What-
they last in the Super Bowl?
Never.
I was gonna say.
Yeah, they should have been last year.
Sorry.
Yeah, they
They
had
should've-
so many injuries. Yeah.
They should have been. So he's gonna play. So he's gonna play in front of
Game-
100,000
Yeah.
seats.
100,000 seats. Yeah.
100,000 seats.
They give him an hour to play this game, so they got like no halftime. Like we got it because there's all these games, but he gets to finish the season.
How old
at the
is
Big
he?
House. He's 8.
8. That's it. He'll remember that. He'll
incredible.
remember that for the rest of his life.
Yes.
Can I say what I'm excited for? I'm excited for tomorrow. If somebody told me 15 years ago that I'd be interviewing Jim Cramer with Josh, I would have thought
Oh my
they were
God.
smoking dust.
Oh,
know
is he
what-
on the pod?
Yeah.
He's on the pod tomorrow night. We're gonna do it live. It won't air until next week. I don't know how long we have him for, but we're gonna do like the Jim Cramer on the compound experience.
Where are you guys doing it at?
We have a venue, holds about 120 people. It's fairly exclusive. And
Custom cocktails?
in the financial district. I don't know about that's a Nicole question. We're gonna do it. I don't know, Rob. We're gonna do it right.
And
right?
thank you, KKR, for sponsoring the show tomorrow.
Oh my God.
All right. Anyway, something to look forward to. Guys, we want to thank our guest, Sonali Basak. Where can people learn more and get more of your insights? Because I feel like you just absolutely lit it up on the show tonight.
Yeah, we keep it real on LinkedIn. We are on Twitter. We try to share as much as we can.
Okay,
And on iCapital.com.
Your Twitter as your real name. iCapital.com. People could subscribe to the research that you guys put out.
Yep. Yeah,
Okay.
we have a newsletter where we share a lot of that research, and we have a tab under Thought Leadership where we publish every week.
All right. You're the best. Thank you so much for being here. Appreciate it. Thanks to all the listeners. Like and subscribe. See you soon.